Admit all.
Oh,
Good morning, Adrian.
Morning, Steve.
Morning, Michael.
Yes.
Good morning, Egan. Morning, William.
Morning, everyone.
Nice to see everybody. Morning, morning, morning. If you've just joined, if you could mute, please, in good old-fashioned playpen fashion. Morning, Elspeth. I love calling you Elspeth. God, it's so funny. Egan, nice to see you.
Still
Michael.
using her computer, Steve.
And still using it. Yeah. Do you want to buy you a laptop, Colin? Shall I just buy you a laptop just to get this sorted? So.
Well, no, I've got a brand new one. I just can't make the fucking thing work properly. Yeah.
Okay.
It's quite bizarre.
Indeed. I appreciate that. But thanks for joining. Welcome, everybody. Welcome. If you've just joined, if you could go on mute just to cut out any background noise, that'd be great. William, I will mute you as well. Yeah, that's brilliant. Okay. Perfect. So before we start, just to say that we are recording. Everybody thumbs up that we're recording. Billy, Bryn, everybody. Yep, Brian, excellent. So this morning's Playpen session is with Steve Barker, who's Managing Director of Barker Tatham. And today's event is hopefully a little bit more integrated and a little bit more challenging for the attendees. I think Steve is, if you don't know Steve, he'll introduce himself, but he also likes to debate and discuss and challenge you, but equally he'll, if you can challenge him, great. As usual, we will open up the chat room. But if you want to ask a question of Steve or make a point or disagree with Steve, then just raise a hand. That's the traditional Pension Playpen fashion. Today's recording and today's podcast will post up later on this afternoon for those that cannot attend. But without any further ado, Steve, I'll pass to you and you can introduce yourself. And we're looking at the investment implications of the DB funding code. So over to you, Steve.
Thanks, Steve. So as Steve said, my name's Steve Barker. I'm an investment consultant, along with Charles Tatham, who's also on this call. We run a couple of investment consulting practices, primarily looking at the smaller end of the market. So I do have a bias towards smaller schemes rather than larger ones. And as is typical for an investment consultant, for those of you who don't know me, I'm quite opinionated. I tend to have strong views in most things in investments. And if I'm given a slot like this, typically what I'll do is I'll talk at you for half an hour. I'll then take questions and sort of defend the position I had at the start. I want to do something different this time with the DB funding code. I don't know how many of you have read through it. But it's quite a long document. There's also, to really understand what's going on, you need to really appreciate the general code from the TPR. You need to have gone through the draft fast track document and also the response to the consultation on the fast track. So you're looking at about 400 pages plus of not the most exciting stuff. Charles and I have been through it over the last few weeks and months where applicable, but I wouldn't say I'm an expert in it. So what I want to do is I want to give you some observations I've got, but I'm not going to pretend I'm an expert on it. And I really would welcome comments, disagreements, questions. Don't wait till the end. Stick your hand up and Steve will bring you into the conversation. And as I said, this is very much from the perspective of the investment side, but it's so intermingled that there might be some observations that are wider than purely investments. Okay, so some of the observations I've got are pretty trivial. Some of them hopefully less so. So the first one was going through all the various documents that have come out and the funding code. My personal feeling is that it feels like the regulator was absolutely desperate to be very, very prescriptive about what's going on and then sort of reined themselves back from time to time. And it's quite there are changes of tone throughout the document. they almost suggest that you have to invest in that low dependency investment allocation, in my view, but then they shy away from it. They almost suggest that you ought to have a journey path to get you to that low dependency investment allocation, and then sort of shy away from it. Some of the stuff's in the fast track, which pushes you in a direction, but they shy away from it. They even, in the introduction, the first few pages of the document, they define what they mean when they say must, when they say should, and when they say need to. And I think they've been quite careful on that side of things. And they also have quite an interesting phrase which came up a few times, which I thought was interesting to see it from them, because it went against a lot of what they were saying elsewhere, and that was this phrase: however, trustees have a legal duty to choose investments that are in the best financial interests of scheme members and are not required to invest in line with the low dependency investment allocation even after the relevant date. So from a personal point of view, I thought that was interesting, and I think what it means is we'll only really see how the regulator deals with this once we've been through a few, and hence going back to what I said at the start, which is I don't see myself as an expert, and I think I'll only really have a practical idea of how this is going to be dealt with, how our schemes are going to cope with it, once we've been through this process a few times. On a separate note, I'm going to get very tired of saying low dependency investment allocation, or even LDIA. It's a bit of a mouthful. I'm going to start calling it Lydia. I hope that catches on a bit, but excuse me if that's where I go. The second observation, which is I think quite important for schemes at the end of the market that we typically deal with, is that I think now that all schemes have to review their investment strategy every valuation. So as an investment consultant, I've always been slightly jealous of scheme actuaries with my commercial hat on, in terms of regardless of how fee resistant or otherwise schemes are, they have to have an actuarial valuation every 3 years. They don't have a choice about it. It's got to be done. Whereas for many years, our single biggest competitor at the smaller end of the market was do nothing, or get very little advice. When statements of investment principles were brought in, there was something about reviewing your SIP every 3 years at least, but not all schemes had to do that, or had to have a SIP. And it felt like the tail was wagging the dog a little bit, in terms of you needed to review your document. Does that mean you need to review your strategy or not? Whereas now it feels like it's very much embedded within the actuarial valuation process. So from a commercial point of view, that's pretty helpful for me and Charles. My third observation is that the investment consultant is going to have to work a lot more closely with the scheme actuary than we had to previously. Now, there's always had to be some sort of collaboration between scheme actuaries and investment consultants, in that changes made to the investment strategy have implications to the discount rate that can be used. The methodology used by the actuary in doing the valuation can have ramifications in terms of risk and modelling on the investment side. So there's always been a bit of a link. But now I think the link is that much stronger, and there are more steps where we hand from one to another when you do an actuarial review process. So again, this might not be how it works out in practice all the time, but my understanding is that the first step with an actuarial valuation will be the trustees will need to decide where they're going to try and get to, in terms of whether they're going to be looking to close the scheme, whether they're going to be looking to run it on, whether they're going to be going to a consolidator. So that would be the first step. And I imagine they'll get a fair bit of advice from the actuary on that bit. The second step, in my understanding, would be the actuaries will need to calculate the date of significant maturity. So that'll be the point at which effectively the duration of the liabilities is 10 years or less. And off the back of that, the trustees will need to then set their relevant date. I can't for the life of me think why their relevant date wouldn't be the same as that, but it can't be after the date of significant maturity. So basically, the second step is to get to the point where we know when the scheme's got 10 years of duration left or less. That's when we'll probably come in. So we'll help the trustees set the LIDIA, the low dependency investment allocation. And I'll touch on that a bit later, what we think that might look like. And then the trustees need to set the investment strategy for not only for the now, but also put in place a prospective journey path of how they're going to get to the LIDIA by the relevant date, and have that path in place. Now, in the regulations, you don't necessarily need to stick to that path, but it does say that the TPR is expecting you to follow pretty closely. So it'll be interesting to see how much that actually ties people's hands. The valuation assumptions are then going to be using not only the current investment strategy, but also the journey path and the LIDIA to come up with the expected returns. The actuary will then do their stuff, and then there's a jointly drafted statement of strategy that will be placed in. And for me, that's more steps, more moving parts than there were before, where there were moments where the actuary and the investment consultant had to work together, but there was more. We could work a little bit more independently than that. Has anyone got any comments so far? Is that no? Okay, I will.
No, not yet. No.
Back on. One thing that also occurred to me going through this, and it has been a trend, I think, over the last 10, 15 years, maybe more, has been pension schemes are starting to act a little bit more like insurance companies when it comes to appetite for risk. Now, just under 30 years ago, I moved from working for an insurance company on the investment side, as commercial union as it was, to this side of the fence on pensions. And one of the things that sort of puzzled me at first was the different way that the level of solvency affected the appetite for risk. So insurance companies have always been more risk averse the worse their solvency was. Effectively, they would bet the surplus at most. If they had a big surplus, they were happy with more growth assets and take more risk. As that surplus shrunk, they would be more and more conservative. Whereas pension schemes were always the other way around. That always seemed to be the bigger the deficit and the worse the solvency, the more the trustees were willing to roll the dice. And then as schemes became better and better funded, the solvency position improved. They would start to lock in, start to take less risk. And it took a while for me to get my head around why that was the case. Insurance companies would gamble with the surplus, pension schemes gambling with the deficit. They have got different regimes, but looking at the way things are going, looking at the way the funding code's gone, it looks like we're starting to move towards a position where schemes are going to be probably more inclined to use growth assets to match their the surplus over the 100% funded on a low dependency basis, rather than going all out on the deficit. I think that's a trend, but I think that will continue.
Steve, we've got a thing in the chat regarding from Peter Cameron Bound. Peter, do you want to make your point for perhaps some people brought up to date on the DWP committee third report? Do you want to just make your point there, Peter?
Yes, sure. Yes, the funding code to me by using is predominantly based on their previous technical provisions for requirements, if you like, valuation methodology, which in turn is based on the Section 75 debt calculation as defined in the 1995 Pensions Act, which is the actuary's estimate of the insurance company buyout cost of the liabilities of the pension scheme. That's how it's defined in the 1995 Act. And it appears to me that the TPR have a mindset that this is the basis on which they value everything. So the DB funding code is an application of that, a continuing application of that. Now, the reason for them doing that in the first instance is the protection of the PPF, which the House of Commons DWP committee, after a call for evidence session, I think in last November, but in, I think it's April, they published their third report, which said that the TPR's objective to protect the Pension Protection Fund was no longer required and should be removed from the 2004 Pensions Act, and instead the TPR's objectives should be changed to protect the future pension benefits as well as the past pension benefits of members of occupational pension schemes. So I do wonder whether the code will have much longevity, and that it will have to be reviewed in the light of different things. On terms of significant maturity, to me it strikes that the objective is clear that we are trying to secure sufficient cash flow to meet the pension benefits as they fall due. And in schemes in the final stages, that means that they're having to sell capital assets. And it's really the control of the capital assets rundown that should be the objective in the final stages of scheme life, if you like. And this gives a different perspective to the value of those assets should you be investing in assets that are likely to increase in value between now and the time in which they're going to be required, or do you try and secure the maximum income now so that you have to sell fewer assets in the intervening period? So that's my view on why I think attitudes may well change, and we might not see the code being in force for a very long period, but that's my own personal view.
Thanks, Peter. Steve, what do you think of that?
Yeah, it's an interesting take. I wasn't aware that they were looking at possibly removing the protection of the PPF as an objective. I think it's about time, because I think there's been a massive conflict of interest for the regulator in terms of what it's trying to achieve. And it does look as if most of the actions by the regulator have been to protect the PPF at the expense of all the other objectives that they've got. Having said that, I'm not as optimistic as Peter, if you want to call it that, that means they will change. Regulators love to regulate. If they find ways of reducing risk, that tends to be the direction of travel. We sometimes get a little bit of pushback, and I don't know if you guys remember, it was several years ago where the government added an additional objective for the TPR. And I can't remember the exact wording, but it was along the lines of looking after the viability of the scheme sponsors, or I can't remember exactly how it's phrased, but basically it was an acknowledgement that if you try and get schemes fully funded on the strongest basis as soon as possible, you're going to destroy a lot of economic value, and maybe keeping the companies alive might be a nice idea to do as well. And it seemed to be that from our experience, that the regulators seemed to relax a little bit what they were doing for maybe a year or two, and then forgot about it and kept ratcheting down in terms of risk and what they're looking for. So I find it tends to be a one-way street that that we're going down. But I think it's an interesting thing if they do get the protection of the PPF taken off them as an objective. But thanks for that comment, Peter.
Yeah, just one little thing is I have suggested elsewhere that in fact the government might well change the regulatory environment to put all pension schemes and pension arrangements under a single regulatory authority, combining the TPR, FCA and the insurance company annuity products, so that they have a single investment objective, and so there's not the inefficiencies of switching between the various things. But that's a side issue.
Yeah, well, I think it does make a lot of sense. It's always been odd that there's been a radically different regulatory environment for pension liabilities that are outside of occupational pension scheme, and it did lead to.
Oh, I think you may have frozen there, Steve. He'll be back in a sec, ladies and gentlemen. Peter, if you mute, I'll bring Shay in and let's have a quick chat with Shay. Shay, you got your hand raised. I'm assuming I think that
yes,
Steve can hear us.
So. Thank you, Steve. I just had a question. I just had a question for Peter. Peter, I was just wondering if you would be so kind as to give me the name of that report. You spoke about the third report in April, which I was thinking about removing that clause with respect to the PPF. Do you know what the name of that report is?
Yes, it's. I'll try and I'll put onto the chat a web reference. Do you see my previous web references?
Yes, thank you very much. Thank you.
Yeah,
thanks so much.
Thank you, Peter, and thank you, Shay.
Can I just come in?
Steve,
that report is the Work and Pensions Committee report. It's the Parliamentary Work and Pensions Committee report. You can obtain it on gov.parliament.
Okay.
Thanks very much, Con.
Thank you very much. Brilliant.
Am I back? You're back.
You're back. You froze for about 10 seconds, but yeah,
okay.
You're back now. So, yeah.
I can't see because most people have got their screens off, which means that if everyone freezes, I don't notice as I would normally. Okay. Going down the list of things that observations that we've got. One is quite a subtle change that with the investment strategy in the past, trustees needed to consult with the employer, but didn't need to take into account anything they said necessarily. Whereas now it is that you need to get the agreement. Strategy. Now, in practice, I'm not sure it's going to make a lot of difference. I've been racking my brains to think of an example of a client we've had where the trustees have consulted with the sponsor. The sponsor's come back and said, no, I don't want you to do that. And the trustees have done it anyway. But it is a change. And we'll see if that has any impact on things. Another observation I've got is obviously this new regime only applies to valuations that happen after Sunday. So 22nd of September. But I think as an investment consultant and probably as scheme actuaries, it is something we ought to be worried about for valuations with the due date or as with the date before then. So valuations that we're currently working on. And I'll give you one example. We've got a client where their duration as calculated under this methodology would be about 6 years. So they've already gone past the significant maturity date. So their relevant date's already been and gone. Now they're in the middle of doing their valuation. So they've got another 3-year period before they need to do a valuation under this regime. And that leads to a bit of a dilemma because it's quite a poorly funded scheme. with a sponsor that is not in great shape, contributions are going to be very difficult to get out of them. And currently they've got a reasonably high proportion in growth assets. So we've got a dilemma of, do you take into account the new funding code? And we don't know it's definitely going to be in existence in 3 years' time, as Peter pointed out, but there's a high probability that if it's not there, that something similar might be. And it might be the last 3 years that they can have a significant exposure to growth assets such as equities before they have to pretty much head for the hills and go primarily into bond-like instruments. So you could take the attitude of fill your boots while you can. It's the last time that you're going to make any inroads on your deficit through significant investment outperformance. But the trouble with that is that the whole point of going for a low risk strategy with a 10 years maturity is that the shorter the time horizon you've got, the less chance there is for the risks to work out in your favor. The expected return year on year is the same, but the volatility is going to be greater. The range of outcomes is going to be greater if you've got a shorter period than if you've got a longer period. And if 10 years is deemed too short a period to gamble on equities and to basically make use of an equity risk premium, then surely a 3-year period and until you've got to actually sell off your investment, your growth assets largely, is completely reckless. So we haven't yet had that discussion with the client, but I think there might be some serious discussions with clients where this doesn't bite for a while, but it's a relatively short time period until it does bite, and you've got this dilemma: do you take risk while you can, or do you start taking risk off the table so that you're not exposed to fluctuations over the next 3 years? I don't know if anyone else has come up against that sort of scenario. No.
Anybody had that scenario? No. Okay, moving on.
Okay, moving on. I'm actually rattling through this quicker than I was expecting. Okay, the significant maturity calculations. It was quite amusing is probably not the right word, but when Kwasi and Liz Truss had their little mini budget and the LDI market went completely berserk, Charles and I were both at the ACA conference, and the regulator was going to be was due to speak to roomful of actuaries on basically the day it was happening, and talking about this new funding code. And you had the issue where they were looking at defining significant maturity as 12 years duration, but overnight duration of pension schemes were coming down dramatically just because long-term interest rates have risen. So I think what they've done is pretty sensible in terms of locking the date that you use assumptions. So you're not going to get the case where if you do the calculation of duration one day, it might be 11 years, and then 6 weeks later that duration might be 8 years. So you're not going to get that. And they have knocked a little bit off, so they've brought it down to 10 years rather than 12, which I think is quite reasonable. But it still could lead to some interesting issues or problems, I think. So if you had a scheme, and I'm thinking out loud here, what actually happens might be different. But if you had a scheme where they had a duration as at the valuation date of say 9.9 years, as you calculate, where they've got a significant deficit and payments that are much larger than can comfortably be made. It does make me wonder whether it might be in the interest of the sponsor to grant some additional bonus liabilities. So, for example, if you could pick the sickest pensioner in your scheme, who and you could say, right, we're going to pay you £10 million on your 150th birthday. That obviously that's not going to cost them anything in terms of the promise. Just to get the duration of the scheme up past from the 9.9 to the 10 years. Now, because the value of that liability is pretty close to zero, it's not going to do that on its own unless they choose to make a very, very prudent assumption about the life expectancy of that one individual, whereby they say that we're just to be conservative, we're going to assume that he's going to live to be at least 160. That would push the duration up, and if you get past the 9.9 years to 10.1, all of a sudden, from 9.9 to 10.1, the recovery period that you can use goes from 3 years to 6 years, and you might effectively halve your halve the recovery payments that you need to make in the next 3 years just by doing that. Now, I've been a little bit facetious. I don't think anyone's actually going to do quite that, but there might be some manipulation. There might be some cases where it's worthwhile for the scheme to use ultra conservative assumptions for mortality, which will increase the liabilities a bit, but it will push them out. Because most of the restrictions on how you can value the liabilities are more on the interest rate and inflation bit. It's just something, I mean, in practice, it probably won't affect many schemes, but I just wonder whether that might be something that might come up in discussion occasionally for schemes that are right on that border.
If you adopted that approach, I'm not saying you can or you can't, I'm just asking the question. If you adopted that approach and that would come from the sponsor, what do you think the trustees' response would be? Because the trustees have to act as prudent, men, women. Surely if an employer said, well, we're going to give our Fred this amazing promise, surely the trustees would push back on that. And what power would they have to push back on that?
Yeah, I personally, I think it would only be with the sponsors working with it'd be the sponsor, it would be the trustees working with the sponsors to do that. Now, for this, putting 10 million, if it's £1 billion scheme, that's not going to work. But the size of schemes that we deal with, that might be where it something of that nature. Now, granting additional benefits is probably not the way they do it. They might manipulate some of the other assumptions, and I was doing it to make a point. But in theory, you could, if the sponsor and the trustees were both in agreement, I mean, you could even buy some reinsurance possibly for that. It would cost almost nothing, because the chance, if you pick, an 85-year-old who's in ill health, and to promise to pay them £10 million if they reach 150, I don't think the insurance premium for that's going to be particularly large. And it might be part of an overall discussion with the trustees and sponsor about everything else they're doing with the scheme. I've sort of exaggerated to make a case that because it's because there's this cliff edge whereby if your duration is less than 10 years or less, you've got a 3-year recovery plan. If it's a day more than 10 years, you've got a 6-year recovery plan. So there's got to be some ways that you can, if you're very, very close to that border, it'd be amazing. And if schemes are really up against it, it'd be amazing if there isn't some thought as to, well, how can we manipulate this so that it just goes just slightly over? Because although there's not much flexibility in the way way that the calculation is going to be made. There is some, and if there is some flexibility, it does make me wonder how it might be abused or exploited or manipulated. But it would have to be between the trustees and the sponsor, I think.
Yeah, okay. Con, you've suggested in the chat about changing the cash commutation level. That's an easy win, presumably, that is an option?
Is 1-for-1.
Yeah.
If you take your cash commutation down from 25% to say 20%, you increase the duration by, as near as makes no difference, 5%. Actually, a little bit more than 5%, but the idea of using duration as a measure of maturity is nonsensical. If they wanted to get it accurately, they should simply have used average life, which doesn't contain a discount rate. The discount rate is the problem with the idea of measuring significant maturity in that way.
Yeah. Okay.
Yeah. I mean, that was definitely a problem with their original assumption. So at the time of the mini budget, it became very apparent that the reliance on the discount rate and the link to the discount rate made it very, very unstable and really unsuitable as a way of planning. So I think they've addressed that to a degree. But even if you did it with life expectancy, the weighted average life, you've still got issues about, well, what assumptions are you using? Because it's one of these weird ones where if you use more conservative assumptions, which normally the regulator's really happy with, it means that you can lead potentially to a less conservative funding strategy, because you're just buying yourself extra time. And I think that might potentially be open to manipulation. Is too strong a word, but if you've got things that are right on the border,
abuse,
it might be something you look at.
Yeah, abuse. Chris Giles, you made a point regarding this in the chat, Chris. Do you want to tell us your opinion about changing that discount rate, maybe, Chris?
Yes, Steve. The point I was making is that, and it goes back really to the fact that the discount process has been a problem for more than a decade, essentially since QE arrived and the gilt market got distorted. So therefore, we've had this strange situation that gilts have been, just purely as an investment, have been vastly overvalued for many years. But the interesting rate that hasn't changed over all that time. So when gilts were on a real yield of -2.5 and a nominal yield of 1, that's inflation expectation of 3.5. We've been in the 3.5 throughout the last 10, 15 years. And arguably that is the most important. If we're going to use a discount process, that's the most important rate we should be using. I would argue, certainly for open schemes, we should probably be funding on a cash flow basis anyway and not going down the discount route.
Okay, Steve, do you agree with that?
I've got some sympathy for it, but I think we've gone so far down this route that I cannot see the regulators going back from that. That one of the things they seem very difficult and loath to do is giving the actuaries permission to use their judgment, which is a pity. But I think that is the direction of travel.
But they don't need to use their judgment on something like the long-term inflation expectation. You can calculate it from the gilt market, but if you don't trust the gilt market, you can calculate it from the swaps market.
Yeah, but I mean, sure, but what you're talking about is not using
the market rate. It's just the wrong market rate has been used for the last decade.
Yeah, but the point is, I mean, you can get market expectations of inflation from either the break-even inflation rate between gilts and index-linked gilts, or the swaps market, and that's fine. And predominantly that is what's been used, but you do need a discount rate of some description, a nominal discount rate on top of that. You can't just have an inflation assumption, because you're going to have some liability.
Sorry, Steve, my point is that if you want to go down the discount route, that the long-term so an inflation plus rate rather than a gilt plus rate is a much steadier rate to use and won't cause all the problems that you highlighted in 2022, where you suddenly within a few weeks you've changed the complete financial position of the whole, arguably the whole country.
When I was in short trousers and doing the actuarial exams, the way valuations were being done at that stage was to do exactly that, not exactly that, but to have fixed long-term assumptions about discount rates. But what it meant was, when you compared the assets to the liabilities, the assets would be very volatile, whereas the liabilities would be incredibly stable. And it was quite inconsistent, the way in which the two were compared one to the other. So we had, with hindsight, it looks really wacky, but it did sort of make some sort of sense at the time. There'd be an adjustment to the value of the assets. So you'd have this weird situation where trustee, in the actual valuation, the trustees would be told, look, your equity portfolio is sort of meant to be worth 100 million, but because of where long-term interest rates are, and to make your assets consistent with your liabilities, we're going to discount those back down to 90 million or put a premium on them to 110, just to keep the two things relatively stable. So we have sort of been there before. I've got some sympathy with it as a view, but I just cannot see the regulator going back. It's, we've had layer upon layer of regulation that's sort of nudged and pushed and nudged till we got to this situation. Starting with the accountants, looking for their, they're always very wary of actuaries using anything like judgment to do it. And it would be a massive judgment call to actually change the basis so that we used fixed metrics for the discount rate and change everything else.
Sorry, Steve, I'm not talking about an absolute fix. I'm just talking about an inflation plus based on that's because ultimately that's what the liability, the two things that matter most to a DB pension scheme are obviously rate of mortality is an important contributor, but ultimately it's the rate at which the liabilities increase, isn't it? That's why a lot of DB schemes of contribution rates have gone up over the years. It's because the cost of the benefits have gone up.
Yeah, I mean, in the past, before there was so much prescription, we worked with actuaries with pretty much most of the actuarial firms, because we only do investment work. So it means that every actuary we work with comes from a different firm. There are a couple where they base their discount rate on the inflation assumption plus a margin. Yeah. And using the same argument you've made, and it makes sense. The trouble with that is that what it means is that as inflation expectations change, the real liabilities do not change in value. So although the real liabilities are linked to inflation, if we think that inflation, previously we thought it was going to be 3% a year, now we think it's 4% a year, that doesn't matter, because what happens is that you increase the expected amount you're going to have to pay in the future by 1% a year, but you discount it back by an additional 1% a year, and the value doesn't change. So it acts in a really odd way. And if you try and hedge that inflation risk by buying inflation-proofed assets, your inflation-proof assets are moving around because all of a sudden they shot up from 3 to 4% or from 3 down to 2, whatever they've done. And the hedge you've got is working in a very, very different way to the liabilities. And even worse, you get that any nominal liabilities you've got, if inflation expectations rise, the amount that you've got to pay or you're expecting to pay in the future doesn't change, but you're discounting it back by a higher amount. And net, what it means is for these schemes, their liabilities, as calculated by the actuary, are actually negatively correlated to inflation, even though we know that quite a chunk of them, at least, are linked to inflation. So the hedges you put in for short term and trying to get from one valuation to the next actually get you in the wrong direction, and it is very, very difficult to actually make work in practice. But like I said, I just can't. I think I just think we've gone past that, and I just don't think the regulators, even if the regime changes and they get merged with the FCA, and there's a different. I just think the regime is pushing in one direction. Let's face it, DB schemes, they're a legacy problem. When I first started work, I was told, DB schemes are, got a limited lifespan. DC's the future. Now they're still around at the moment, but at some stage they're going down. And I think a lot of these regulations, I think the funding code itself is pushing towards these schemes being closed down, wound up, bought out. Not necessarily in that order. I've got it the wrong way around, but I think we will see. This is putting those last few nails in. For me and Charles, probably we'll still be able to work on DB schemes for our remaining working lifetimes, but I think the guys that work for us are probably going to spend more of the later part of their careers working on DC and other arrangements. So I just can't see the regulators coming back from this.
I mean, I was just going one final comment. I come from the position of wanting to see at least some DB schemes continue, and therefore I'm putting forward something that I believe is the way forward for those who see themselves as still having a future in DB. I'll leave it there.
Okay.
Yeah,
I appreciate that.
I'd fully back you up on that, to be honest. Not just from a commercial point of view, but I think it's a shame what we've done, what collectively we've done to DB.
Okay, we've got a hand raised, Steve. Con, do you want to make a point or challenge or?
Well, I actually want to change the subject a little bit.
Oh, okay.
Steve, the impact assessment associated with the legislation said that the cost of low dependency or self-sufficiency was basically going to be zero, 177 million. My question is, of the schemes that you see, how many are in self-sufficiency or low dependency, if you want to call it that, deficit, and how large are they? How much money can we expect to be demanded from employer sponsors is what I'm trying to get a handle on.
It's a good question. I don't have an exact figure for you, but it is a very low number of our clients that are on what would count as a Lydia compliant sort of arrangement. So I think there'll be a lot of schemes that will need to take significant risk off the table. That'll be expected returns that aren't gained by the pension scheme. That'll mean there'll be additional contributions that are needed to be paid by the sponsor. The funding strategy is going to imply that contributions are going to have to come from the sponsor sooner rather than later. There's going to be very few schemes where they will take a less conservative approach than before, and there will be a cost for that. So, kind of, I share your skepticism about that number. I think, but I think a lot of this cost has been borne already in that layers and layers of regulations have pushed us down a path. This is sort of securing us to get through, the last few gates, but it's a path that we've been heading down, and it is a shame. The pension scheme, DB pension schemes, particularly ones where they're still open, they should be long-term investors. They shouldn't be worried about short-term volatility. But that is the focus, and I understand why. The spectre of schemes closing with the sponsor bust and pension, people not getting what they were meant to. It's horrendous, and there's a knee-jerk reaction. And I understand why that is, but we have sacrificed an awful lot as a society, in my view, in order to prevent what is serious for the members, but prevent the occasional problem. But again, I don't think there's a lot we can do about it at this stage. I think the damage has been done, and the direction of travel is pretty well set. Even if they didn't have this new funding code, I think this is a direction that we're heading in for quite some time anyway. But I agree with you. I think they're massively underestimating things. Well, I mean, one of the other observations that I was going to come on to was about, it's sort of laughable when you had the Mansion House proposals.
Yeah.
I went into a meeting with Andrew Griffith, who was the city minister at the time, with the heads of most of the investment consulting practices, and they were talking about this. And I told him it's laughable that you expect DB schemes to be invested in this way, because that ship has long sailed. There is a case for it in DC, and hopefully there'll be more done in that area. But DB, I think that's a lost cause as far as.
Well, I mean, it drives a coach and horses through the government's productive investment objective. Yeah. Because if you're going to be making those demands on companies, and it's companies who actually produce the most productive investments that matter within our economy, I think it won't take very long for the Chancellor to realise the pension regulatory strategy is what's stymieing their investment agenda. And if you want a trigger for the breakup of TPR, I think that's likely to be it. I think that the more likely breakup of the pension regulator is actually to take DB, what's left of it, and put it under the auspices of the PRA along with the bulk annuity insurers, and take the DC and give that to the FCA to manage. Yeah, I'm still trying to get a handle on what the costs are, and I suspect that they are going to be really rather substantial.
Without, but I think they're going to be very hard to measure.
Yeah.
But without a doubt, I think they're larger than they're meant to be. I mean, I don't share your optimism about what might happen. I don't think it will be big enough, and I think the other thing about this is that we have seen where, as I said, where the regulator had a shot across the bow saying you're doing too much harm to the economy, back off a bit. And it lasted for a year and a half or whatever, and then they were back on the ratcheting down in terms of risk. Because the other thing about this is that if you're a sponsor of a scheme or trustees of the scheme, and you've seen the way that things have been regulated and risk coming down, funding levels going up, more conservative both investment and funding strategies, I don't think they would trust any regulators, even if the regulators said, you know what, we've got it wrong, invest how you like, you are long-term investors, you should be investing in productive finance, you should be investing in growth assets, you can afford to take this risk, and that is for the benefit of not just your members and your just. I just don't think it'll be credible enough to actually change.
Well, I will make one point. The regulator can't actually direct you how to invest. They do not have that power, and they've never had that power. And I'm rather surprised that so many people have been browbeaten by the regulator into de-risking in the manner that they did. But anyway, that's neither here nor
It
there.
is, yeah. We've got a hand raised, Steve. Peter Cameron Brown, you going to make a point, Peter? You got a hand raised?
Sorry, I was trying to unmute. Yeah, just to sort of amplify on Con's point, the pensions review by the Labour government has focused on, has apparently ignored DB pension schemes, but it hasn't, because the first item on their agenda is the DB local government pension schemes, where they are seeking to encourage productive investment in that. So I think that is very much on their agenda, and I think it is purely sort of priorities that means that they're not addressing the DB pension world at this stage. That's all I was going to say.
Thank you, Peter. Bryn, you've had your hand raised as well. Bryn, do you want to say a few things or challenge Steve? Or
well, I hesitate, but I don't think Con is quite right about the powers of the regulator. It all depends whether the trustees have to produce the deficit plan. If the scheme's in surplus on their basis, fine. The regulator can't do anything. But if they don't like the deficit plan the trustees come up with, they can put in their trustees to run the scheme. They've never done it, as far as I'm aware. I don't know if anyone can correct me on that. But ultimately, the regulator does have these powers, and so they can't say to the existing trustees, this is how you should invest, but they can say, we don't like you as trustees, we'll have our trustees in instead. And I think that's sort of hovering in people's minds, even if it's never actually been applied. Perhaps Con thinks I'm wrong, but my understanding.
Are you wrong, Con?
No. He's not wrong. My comment was made specifically with respect to the regulator having power over investment strategy. The question of replacement of trustees, Bryn is correct on. To the best of my knowledge, it's never been done. I can't help feeling that if they were to attempt to do it, the result would be rather a lot of lawsuits. Could you possibly introduce a trustee as the regulator and not have liability for doing that? And I think that's a point which would drive the regulator away from actually doing it. I think it's probably the reason they have never ever done it. But getting away from the thrust of this, Steve, back to you.
Okay, thank you. Rodrigo, you've got your hand raised, and then we'll come back to Steve. Rodrigo, do you want to ask a question, Rodrigo? If you can unmute.
Sure, yeah, thanks for that. I mean, I guess I just wanted to see if we could just maybe focus back on what you think the investment implications are in terms of around the hedging strategies, because I guess you've clearly outlined that when you get to that 10-year duration that you've got to be in this Lydia portfolio, which appropriately starts with LDI. So, I mean, I guess there'll be a lot of funds that will be already quite well hedged anyway in this current environment. So do you really think it's actually at the margins, there'll be the example of some schemes that you've mentioned, which I assume are probably now a minority that are heavily in growth assets. Most of them will all be heavily de-risked already. So how, the big picture, how do you think the investment strategies will change just off the back of this?
Yeah, I think it might make less difference in terms of LDI, particularly for our clients. I mean, traditionally, what we've always recommended hedging interest rates and inflation, regardless of how much risk you're taking. So even schemes where they've got big exposure to growth assets, whatever they put into bonds, we try and get rid of as much interest rate and inflation risk as possible. So using leveraged exposure to gilts, i.e. LDI funds, is a way of doing that. I think when you get to the Lydia, And remember, you don't actually need to invest in Lydia. I mean, it sort of goes back to what Con was saying, in that they're not actually forcing you to invest in a certain way, but they're sort of strong arming you to at least consider it. But within the Lydia type of arrangement, they're talking about at least 90% hedging interest rate and inflation risk. Now, looking at, they think there might be about 15%, up to 15% in growth. Again, they're not imposing that, but there's restrictions on what you can do with the stress test around that. It's probably about the figure you might see as the top end. You've got a scheme by definition where the duration is going to be 10 years or less. If you've got 90% in growth in hedging assets, you don't need to use LDI at that stage. You can use standard bond funds to get the interest rate and inflation hedging. So by the time they get to Lydia, I don't think they'll need LDI. But before that, going into it, I think LDI could be part, because you've got to get your the volatility of your funding level as measured by a stress test or equivalent down to a certain level at various stages as you go through your journey path. Getting rid of the interest rate and inflation exposure before then is going to make that so much easier to do than if you tried to run unhedged interest rate and inflation risks. So long story short, I don't think it's going to affect much the way that our clients are using LDI, because we use it quite a lot for schemes where they've got high growth allocations already. I think that'll still be the case. I mean, what have you got a particular view on this?
That makes sense that you're saying that when you get to that 10-year duration, in theory, you shouldn't be so leveraged anyway, because you should be better funded.
Yeah.
But I guess it's so it's more just that you get forced into having to be stricter on your discount rate, because you have to go into gilts plus 50, I think, isn't it? That they're saying by that point you can't deviate too much from the gilts plus 50, whereas maybe you could have had a. So does that push you into more hedging because you're?
It may, from my perspective, it makes the hedging easier. In that, as I say, we've got a variety of different actuaries that we work with that use different methodologies to derive their discount rate. The one that makes my life as easy as possible is where they're using gilts plus as the base. It doesn't even matter what the plus is, but a gilts plus type of discount rate is quite easy to hedge. One of the hardest ones, and it got me scratching my head for a long time, as we discussed earlier, when people were using inflation plus as the starting point for the discount rate. Because that did weird and wacky things to the behaviour of the liabilities. But sometimes you get a mixture. Sometimes you use corporate bonds or some sort of proxy for equity in part of the discount rate. And I think what this is going to do is it's going to more homogenise what we see, and it'll probably make our life easier. The other thing about the Lydia, and again, I don't know if this is how it's going to pan out, but it is only a notional investment. You don't actually have to invest in this way. And as part of an actuarial valuation, you need to establish what your Lydia is going to be. And it is one area where there's a proportionality aspect to the funding code. And it's not based on the size of the scheme, which is unfortunate, but it's based on how far away you are from your relevant date. So basically, the less mature the scheme and the further they've got until they've got to get to Lydia, the less granular, the less thinking you've got to do about what that Lydia would be. Now, at the moment, I don't think it's probably worth spending an awful lot of time and energy thinking about the Lydia for schemes where they've got a decent amount of time until they reach significant maturity, in as much as it's not something you have to invest in. You're not committing to invest in that way. The only thing that does is it helps drive the actuarial assumption that can be used for the actuary to do the valuation. There's an upper limit of gilts plus a half. So there's absolutely no point sort of shooting the lights out and being clever and coming up with strategies where your long-term investment strategy would give you more than gilts plus a half. So, for example, if you put 50-50 in corporate bonds and gilts and cash, it'd be, to my mind, it would be quite easy to justify gilts plus a half on that. So the job's done. So doing anything cleverer than that, there'd be no point. Obviously, when you get closer, and once you do get to that point at which you're past your relevant date, and you actually have to invest in something, then it would be worth looking at exactly what that entails. But I'm starting to come around to the view that we do some work, some really basic work, and pretty much all of our clients have very, very similar looking Lydias until they get very close to actually needing to invest in one, with the exception of the inflation exposure they've got. But even so, you could still probably do, even if it's 100% inflation-proof liabilities, you could probably still fully hedge it using 50% in corporate bonds, 50% in linkers, and you have some cash in there.
Okay, Steve, brilliant. We've got we're
sorry,
slightly over, but we've got one.
Oh, okay.
Sorry, Roger. Yeah, go back. Sorry, I thought you're happy now.
More or less, I guess there was a small follow-on point, and I'll try and make it quick.
That's fine.
Do you think this new funding regime is going to affect the decision to go to buyout or not?
I wouldn't have thought so. What I think it might do is it'll force trustees to think about buyout and how far away they are from that and where they want to get to, just because the first step of the valuation is you've got to work out what you're trying to get to. I mean, I've always found it an odd question to ask, because you're talking, the options are you either buy out if you all go to a third party, but the run on to me just means you're still going to buy out or go to a third party. It just means you're going to push it back a little bit further than you would otherwise. The point at which you buy out or go to a consolidator gets pushed back, because you can't seriously imagine any scheme keep going until the last beneficiary has died. I mean, I find that just I just can't imagine that would happen. It would be just ridiculously expensive. So at some stage you're going to have to do something with the scheme, but I think one of the things about this regime is the trustees will have to explicitly have a discussion about that. But I don't think it's going to have a dramatic impact on the rates of buyout or anything like that. I just think it means that it'll probably be more in the trustee's mind.
Okay.
But who knows?
Rodrigo's thumbs up. Good answer. So last question, Michael. Go on. You're save the best till last, Michael. So if you could unmute, please, that would be great.
Okay.
Excellent. We can hear you.
I see this code rather like a somewhat modernized car, which is towing fast track, a great big case full of fast track. Many of the queries you have raised today, which I think is very, very good, are at least given some hint or more in fast track. And I think, people have been talking about nudges and things. Fast track isn't nudge. I mean, it's what you do. And so I think when we look at the code, one ought to look at fast track as well. By the way, although there's a very big case full of fast track being towed by the little code, there's no case at all for bespoke. No case at all. That is, the regulator doesn't say a word about how they may deal with bespoke. And some of the questions that have been raised today do raise bespoke matters. There you are, that's the end.
Thank you, Michael. And Steve, as a final summary response, what would you say?
I like the analogy, but I think they're not threatening fast track, but it's like being asked by the mafia when they're standing over you with a baseball bat in their hands. You really want to change your mind, don't you? You really do. Yeah. They say that over 50% of schemes already fulfil the fast track requirements of what they're doing. For smaller schemes in particular, the baseball bat they carry is quite a big one, because I think the amount of work that you'll have to do to go down the bespoke route is one that, although it's going to pay for me and Charles, it's probably expense that most schemes are not going to want to do. It's going to be a lot of work, and they've also threatened it on the. I mean, we haven't covered the statement of strategy. There's a part 1 which looks reasonably straightforward, and if you go through the steps before, you're just documenting the decisions you've made. So that's an easy bit. Part 2, they basically said if you're on fast track, you're going to be asked very little on this. If you don't, then there's going to be all sorts of questions you have to answer, which for £1 billion scheme is going to be not an issue. If you're a £5 million scheme, the amount of work involved and the cost of doing that is going to be pretty prohibitive, particularly if you're one of the first to go down that route. So yeah, going back to Con's point, they're not forcing you to do things, but they are making it quite uncomfortable if you don't go down certain routes.
Okay. Good response, Steve. Excellent. Okay, well, listen, Steve, I'm going to wrap up. It's 11:43. You've done a fantastic job today. Raised some very interesting points, made some great points. Big clap from Con, big clap from Michael. Chris, thanks for your questions. Peter, thanks for your questions. Shay, Bryn, everybody else, thank you very much for joining today. And the video will be up and running on the website later on, and the podcast. So when you're in the gym, and Steve, you like your tennis in your gym, you can listen to yourself in the gym. So there you go. So there we are. As usual, we pray for peace in the East and peace in the Middle East. Next week, we have Bobby Ridaway, who's a trustee, talking about ESG and stewardship. So that could be quite interesting as well, just to bring in the ESG and stewardship side of things. And I know a big article's coming out today on professional pensions with that. So, Steve, thank you very much indeed. Brilliant session. I hope everybody enjoyed it. And enjoy the rest of your day, enjoy the rest of your week, and hopefully we'll see you next time on Pension Playpen. Thank you very much indeed. Cheers, Steve.
Cheers, guys.
Thanks a lot. Cheers. Bye. Bye.